JP Morgan Chase Chairman and CEO Jamie Dimon joins us now, along with CNBC's Bertha Coombs. Bertha?
Thanks very much, Kelly. And Jamie, thank you so much for joining us. Had really hoped that we'd be able to do this in person. I want to get to healthcare, but given where the markets are today and some interesting comments you made during the keynote just now, I wanted to start off with the economy. Your sense is that the economy is in good shape. What's telling you that?
Yeah, for Bertha, first of all, I'm thrilled to be here. I think this is our first interview together, so I look forward to it. And, when you look at the economy, the consumer, okay, now, there's all respect to the fact that it's not true for all consumers. There's some still suffering, and we're still kind of working through this. But the consumer balance sheet has never been in better shape. They're spending 25% more today than pre-COVID. They've got $2 trillion in their checking accounts. They have the wherewithal to spend more. They've paid down a lot of debt. Their debt service ratio is better than it's been since we've been keeping records for 50 years. Home prices are up, stock prices are up, jobs are plentiful, wages are going up. And that all tells you what's going to happen in the future. They're in pretty good shape. And businesses, confidence is high, they've got plenty of cash and capital. So underlying, we've had this strong economy. The numbers are herky-jerky. Inflation, growth, employment, unemployment, people going back to work, the great resignation. But that underlying stuff is paramount and is pushing, we're going to have the best growth year we've ever had this year, I think, since, maybe sometime before the Great Depression. And so next year will be pretty good too. And obviously there's some negatives out there, but those things look pretty good. The market is different, Bertha. And, the market can have its own fluctuations and unrelated to the economy. And I think you need kind of this kind of growth to justify the market. So, we're kind of expecting that the market will have a lot of volatility this year as rates go up and people kind of, redo projections and look at, the effective interest rates and businesses differently than they did before.
One of the things that the market is focused on is the Fed. Goldman Sachs coming out this morning saying they now predict that the Fed may actually raise rates 4 times this year. You think the Fed may be able to engineer a soft landing, though?
I hope so. Listen, Bertha, no one knows the future. And I think what you really should do is go back to March of 2020. We were on our way to 15% unemployment, a lot of people dying from COVID, and no known vaccine. Now we've got unemployment around 4%. The consumer's in good shape, business is in good shape, and those things are really good. The Fed, you could say they should have started doing QE a little bit early and stuff like that. But, if we're lucky, they can engineer a slowdown, and you'll see inflation coming down. A lot of people project inflation to be 2.3% at the end of this year. I don't. I think it's going to be higher. But, if we're lucky, the Fed will slow things down, and we'll have what they call a soft landing, and it's going to be a little bit like threading a needle. So you can't look at anything and say, that's my projection, because you really don't know. It's possible that inflation is worse than they think. They have to raise rates more than people think. I'd personally be surprised if it's just 4 increases next year. I think that 4 increases 25 basis points is a very, very little amount and very easy for the economy to absorb.